Welcome to Cost Saver Conversations. I'm Angela, and I ask the practical questions so you can quickly understand what matters. Today, I'm joined by Assad.
Hi, Angela. We are unpacking the UK 60% tax trap, how to keep more of your salary between 100K and 125K today, and tying it back to the wider cost saver ecosystem, including tools like 60% tax trap calculator UK, 100K personal allowance taper, so you can turn insights into action quickly.
Just a heads up before we dive in, we are your synthetic hosts. We are great with numbers, but as AI, we can sometimes be confidently wrong. Think of us as the digital versions of your most knowledgeable, slightly caffeinated friends.
Exactly. Treat this chat as a smart estimate only, not as professional financial guidance. Always check important details with official sources or a qualified expert before making any big decisions.
Welcome back, everyone. So today we're getting into something that, honestly, when I first heard about it, I thought someone was winding me up. The 60% tax trap. Assad, tell me, is this actually a real thing? Because it sounds like something someone made up to scare you.
I wish it were made up, but no, it's very real. And the frustrating part is you won't find a 60% band anywhere on HMRC's website. There's no line in the tax tables that says 60, which is kind of why it catches so many people off guard.
So who does it hit?
Anyone earning between 100,000 and 125,140 pounds, that's the band where it bites.
Wait, that's not even mega earners, is it? That's like senior managers, people who've just got a decent promotion.
Exactly. And here's the kicker. The effective rate in that band is higher than what someone earning 200,000, 500,000 pays on their marginal pound. It's genuinely one of the quirkiest, most punishing bits of the UK tax system.
That is wild. Okay, so walk me through it. Where does the 60% actually come from?
Right, so everyone gets a personal allowance, yeah? For 2024/25, it's 12,570 pounds. That's the bit you earn tax-free.
Right.
But once your adjusted net income, we'll come back to that term, once it goes above 100,000, HMRC starts clawing that allowance back. For every 2 pounds you earn over 100 grand, you lose 1 pound of personal allowance.
Oh, so it doesn't just disappear all at once, it tapers.
Yeah, it tapers. And by the time you hit 125,000, 140, it's gone completely. Zero personal allowance. So here's the maths on a single extra pound in that band. You pay 40 pence in income tax, that's just a higher rate, but you also lose 50 pence of your personal allowance, right? And that 50p would have been tax-free, but now it's taxed at 40%. So that's another 20p.
So 40 plus 20.
60 pence. Gone on 1 pound. And honestly, if you add national insurance on top, you can push past 62%.
That's, honestly, that's brutal. And you're saying people don't even realize this is happening?
A lot of the time, no. HMRC's PAY system just keeps withholding taxes normal. People get a pay rise, they're expecting a nice bump in take-home, and then the payslip lands and they're just staring at it going, where did it all go? Does that make sense?
Yeah, completely. So what does doing nothing actually cost people, like in real money?
For someone sitting mid-band, so around 110, 115,000, doing absolutely nothing costs somewhere between 3,000 and 6,000 pounds a year in avoidable tax.
A year.
A year? Over a decade, that's the price of a family car or a chunky deposit on a buy-to-let. It's not small money.
And I imagine more people are getting pulled into this now because I keep hearing about, what's the phrase? Fiscal drag?
Yeah, fiscal drag. So the thresholds are frozen, right? Frozen through to at least April 2028. But wages keep creeping up. So every year, more people just drift into this band without doing anything differently. It's hitting senior managers, directors getting bonuses, consultants, doctors, lawyers in high billing years, landlords with rental income on top of a salary, business owners taking dividends alongside.
It's a long list.
It really is. And it's getting longer.
Okay, so I also read something about parents getting hit even harder, something about a childcare cliff edge.
Yeah, this one's really rough. So once your adjusted net income goes above 100,000, you lose access to 30 hours of free childcare for 3 and 4-year-olds in England, and you lose tax-free childcare, which is worth up to £2,000 per child per year.
Per child?
Per child. So for a parent with 2 young kids in nursery, that's thousands of pounds on top of the 60% marginal rate. And for that first pound over 100 grand, the effective loss can sometimes exceed 100%.
Wait, over 100%? You're literally worse off for earning more?
Yeah, you genuinely can be worse off earning slightly more. It's one of those things, you know?
That's actually insane. Okay, so you keep mentioning this term, adjusted net income, ANI. That's the number that matters here, right?
That is the number. The trap doesn't care about your gross salary in isolation. It's your total taxable income minus certain deductions. So your salary, bonuses, taxable benefits in kind, things like a company car, private medical insurance, rental income, dividends, savings interest above the allowances, self-employment profits. If it lands on your self-assessment as income, it almost certainly counts.
And I bet people forget about some of those, like a company car benefit. That pushes your ANI up even if you don't see the cash?
Exactly. Your P11D value counts. I mean, a 6,000-pound company car benefit alone could push you significantly deeper into the trap. People just don't think about it.
Okay, so the goal is to get that ANI number down. What's the best way to do that?
Pension contributions, full stop. It's the single most effective tool. When you contribute to a pension, that money comes off your ANI. It doesn't count against the personal allowance taper.
Right, so give me the numbers. Like, what does that actually look like?
Okay, so say you earn 110,000. You put 10,000 into your pension, your ANI drops back to 100,000. Full personal allowance restored. Now, that 10,000-pound contribution gets 40% higher rate relief, so it costs you 6,000 net. But you've also recovered roughly 5,000 pounds of personal allowance, which saves you around 2,000 in tax at 40%.
So the actual cost of putting 10 grand into your pension is,
About 4,000 pounds out of your pocket.
oh, that's 60% tax relief, effectively. You're using the trap against itself.
That's exactly what you're doing, yeah. And if you can do it for salary sacrifice, where your employer reduces your salary by the contribution amount, you save on national insurance too, both employer and employee. It's often the most efficient route.
And there's the bonus sacrifice thing too, right? For when you get a windfall?
Yeah, so if you're due a bonus that's going to tip you into the trap, you ask your employer about bonus sacrifice, divert it straight into the pension, avoids income tax, avoids national insurance, preserves your personal allowance. It's honestly one of the cleanest wins available. A single form, 10 minutes with HR or payroll, done.
Fair enough. What about the annual allowance, though? Is there a limit on how much you can shove in?
Yeah, for 2024-25, it's 60,000 pounds. But, and this is a good one, you can carry forward unused allowance from the previous 3 tax years as long as you were a member of a registered pension scheme in those years. So if you haven't maxed out before, you might be able to contribute more than 60,000 in a single year.
Oh, that's actually reassuring. Okay, so pensions are the big one. What else?
Gift aid donations. If you're charitably inclined anyway, this is, well, it's a really smart way to do it. So when you donate, say, 80 pounds under gift aid, the charity reclaims 20 pounds of basic rate tax, making it a 100-pound gross gift. And that 100-pound gross figure is what comes off your ANI.
So you're reducing your tax bill and supporting a charity at the same time?
Exactly. For someone earning 110,000, donating 8,000 net, which is 10,000 gross, brings the ANI right back down to 100,000. And you get higher rate relief of 20% on the gross donation via your tax return, plus restoration of the personal allowance. It won't suit everyone, but for those already giving, doing it tax efficiently is a no-brainer. Just keep receipts and declare it on self-assessment.
I hadn't thought about it like that. What about timing? Like, can you control when income actually hits?
If you have any control over it, absolutely.
Business owners and directors often have flexibility over dividend timing. You can spread dividends across tax years or defer them to a year when other income is lower. Even some employees in senior roles can negotiate when a bonus is paid. It's rare, but it happens.
And sabbaticals, career breaks, that kind of thing?
Yeah, the tax year it falls in matters. A gap of even a few months can materially change your A&I for that year. And if you're being made redundant, the interaction between statutory payments and pylon and any ex gratia amounts can push you into or out of the trap in a single year. So timing really matters there.
Okay, and I know salary sacrifice isn't just for pensions, right? There are other schemes.
Yeah, there are a few good ones. Cycle to work, electric vehicle leases through your employer, buying additional annual leave, workplace nursery benefits if your employer genuinely provides them. They all reduce your gross salary and therefore your A&I by swapping taxable cash for a non-taxable benefit that's either not taxed or taxed very favorably.
Go on.
Well, the savings on top of the taper avoidance can be substantial, and most employers can set these up within a single pay cycle, so it's not like you need to wait months.
What about couples? If you're married or in a civil partnership, does that open up anything?
It does. Income planning becomes a two-person exercise. You can look at transferring income-producing assets, savings, shares, rental properties, to the lower earning partner where they'll be taxed at a lower rate. Making sure both partners use their ISA allowances, which is $20,000 each per tax year. It doesn't directly reduce your employment A&I, but it stops investment income from pushing you deeper into the trap.
Smart. Okay, so I feel like we should talk about the mistakes people make, because I bet even people who know about this still mess things up.
Oh, absolutely. So the first one, ignoring taxable benefits. Your P11D value counts. That private medical insurance, the company car, even gym membership, it all inflates your A&I. People just forget.
Right.
Second one, forgetting to claim higher rate relief on personal pensions. If you contribute via relief at source, only 20% basic rate relief is added automatically. You have to claim the extra through self-assessment. People leave money on the table all the time with this.
And I imagine leaving things until the last minute is a classic one?
Oh, the March scramble, yes. Pension contributions need to be made and processed before the 5th of April to count for the current tax year. But some providers have cutoffs in mid-March. So if you're trying to sort this on the 31st of March, you might actually miss it.
Ouch. Okay, so let me throw some of the objections at you that I've heard. The big one, I can't lock my money away in a pension. I need cash flow now.
Yeah, I get that. And in a strict sense, yes, pension money isn't accessible until age 55, rising to 57 in 2028. But, and this is the bit people miss, because the relief is so generous inside this trap, you're putting away $10,000 for a net cost of about $4,000. So every £1 of take-home you sacrifice buys you around £2.50 of retirement money. That's a pretty extraordinary return.
When you put it like that.
And honestly, the actions themselves are simple. Increase your pension contribution percentage, sign up for salary sacrifice, set up gift aid. Most of it takes less than half an hour. This isn't just for people with accountants.
What about the worry that HMRC might change the rules?
The taper's been in place since 2010, shows no sign of going anywhere. If anything, the frozen 100,000-pound threshold means it's becoming more entrenched, pulling more people in every year. Acting on today's rules is the sensible play. You can't plan your finances around hypothetical future changes, you know?
Yeah, that's fair. So there was a worked example in the blog. Sarah, can you walk us through that quickly?
Yeah, so Sarah's a marketing director in Manchester, earns $115,000, but she also gets private medical insurance worth $1,200, that's a taxable benefit, and a car allowance of $6,000 paid as taxable cash. So her A&I before any planning is around $122,200. She's deep in the trap.
Okay.
So she salary sacrifices $15,000 into her workplace pension and gives $1,600 net, that's $2,000 gross, to charity via gift aid. Her A&I drops to roughly $105,200, still slightly in the trap, but her personal allowance is largely restored. She saves several £1,000s in tax, gets a bigger pension pot, and supports a cause she cares about.
And if she'd done nothing?
She'd have paid the full 60% marginal rate on over £22,000 of income. The difference is thousands of pounds a year, compounded over a career. It's kind of staggering when you see it laid out.
Okay. One more thing. When should someone actually go and get proper professional advice on this, rather than just DIYing it?
Good question. So DIY is fine for a lot of people, but I'd say consider a chartered financial planner or tax advisor if your income is highly variable year to year, if you've got significant investment or rental income, if you're a company director with dividend flexibility, if you're approaching the tapered annual allowance thresholds, that's threshold income above $200,000 and adjusted income above $260,000, or if you've got overseas income or non-dom considerations. At this income level, the fees for a decent advisor often pay for themselves several times over.
Have I got everything? There's a lot here. Can you give us the quick recap?
Yeah, of course. So look, the 60% tax trap is real. It hits earners between $100,000 and $125,100. It's not an official rate, but it quietly takes 60p of every extra pound. The key is reducing your adjusted net income. Pension contributions are your single best tool, especially via salary sacrifice. Gift aid, other salary sacrifice schemes, timing your income, and couples planning can all help too.
And don't leave it until March.
Please don't leave it until March. Run your numbers through a proper calculator that actually models the taper. The standard ones don't. And just remember, small, deliberate choices made before the 5th of April each year add up to real money, better retirement savings, and a lot less resentment when your payslip lands.
That was brilliant, Assad. Thank you. And if you're listening and you're anywhere near that 100K mark, seriously, go run the numbers. It's worth 10 minutes of your time. We'll catch you next time. Quick side note, this guide connects with other cost-saver blogs, especially company car versus cash allowance decision, redundancy runway mistakes and hidden costs, and tax optimizers versus traditional calculators.
Exactly, and reading those together helps you connect the dots across your household budget, not just this one topic in isolation.
And if you want to apply this immediately, jump into tools like 60% Tax Trap Calculator UK, 100K Personal Allowance Taper right after this episode.
Primary sources used here include gov.uk, income tax rates and personal allowances, and gov.uk personal allowances, so you can verify the data yourself and stay evidence-led.
That wraps this cost-saver conversation with Angela and Assad. If this helped, share it with someone who could put these ideas to work this week.
Your next step is simple. Try 60% Tax Trap Calculator UK, 100K Personal Allowance Taper, then read Company Car vs. Cash Allowance Decision and use them together to take action today.